Welcome to the Insurance and Money Podcast. We're here to educate on the topics of insurance and money. I'm your host, Karla Howard. I want to thank you for tuning into the show today. Today, we will continue our discussion on universal life insurance. While everyone needs life insurance and the different types of insurance, on this show, you can expect to learn about the different types of insurance and how they relate and apply to you. Also, we will discuss your money as well, such as checking and savings accounts, credit cards, and mortgages. On our last episode, we discussed decreasing term insurance, forced place insurance, and homeowners insurance. Let's continue our discussion on universal life insurance. I have been receiving questions on universal life, so we'll cover it in a little more detail. First, I want to remind you that Index Universal Life is not whole life insurance. There are two completely different policies. In some ways, they are similar, but they are very different. Next week, we will go over universal life insurance again, and we will compare universal life and whole life insurance. Also, remember, this is a permanent policy which will last to the end of your life or up until age 100 and 120, depending on the company. And also, I am assuming that you're going to continue making your premium payments. When buying universal life, we have to determine how you wanted to structure the policy. Everyone's situation is different, so you will need an experienced life insurance agent to review and write the policy properly to meet your needs and your family's needs. Index Universal Life offers premium flexibility. Adjustments are allowed within limits. There is a greater potential for greater returns but a slight risk as growth is attached to a market index. However, it's still worth it because there is a guaranteed minimum interest rate, which is a floor to prevent any negative returns so you won't lose money and you'll never see your cash value decreased as a result. The policy has a premium payment. First, it deducts from the policy, the cost of the policy, and the remainder of the premium goes into your cash value. Inside the policy, you'll see on your illustration, there are two sections of cash value on your illustration. You have the fixed rate of return, which is usually anywhere from 2, 3 to 6%. The other section of the cash value section will track a market index like, let's say, for example, the S&P 500. The S&P 500 tracks the performance of the 500 largest cap companies in the US. And different companies will give you access to different indexes. As the index value grows, your cash value will receive index value based on the performance of a cap interest rate. Index universal life policies growth is linked to a market. And the way it works is the index value grows. As your index value grows, your cash value will also receive cash value credits based on a performance up into up into a cap, which means there is a cap for the interest. So growth so for growth, there are interest credits that you will receive, and there is also a floor. So you're not going to lose money. There isn't much of a risk because the interest credit can only go up or it will flatline to zero, which will stop you from losing money. At no time will cash value decrease because of the market. Now let's talk about structuring your IUL. There are two main ways to structure your IUL: death and cash value. For death benefit, the goal here is to have the highest death benefit possible while making it affordable and lasting to age 100. You'll still earn cash value in the illustration. We'll list the fixed rate and the cash value section of the market index. The second way is to structure your policy is your cash value growth. Here, you're looking for the lowest death benefit possible according to the IRS guidelines. The death benefit amount is determined by how much you put into the policy. Having a lower death benefit lowers the overall cost of the policy, so less money goes to the death benefit, but more money goes into cash value. So low death benefit and high cash value focus. There are two main ways to access the cash value in your policy: a loan withdrawal and a loan policy. Loan withdrawal is the least favorite option. This is because you could be subject to taxation if the withdrawal amount is more than what you actually paid into the policy, and that is not what you want. No one needs another tax bill. Now, policy loan. When you get a loan, you are borrowing from the insurance company, and your cash value secures the loan. Also, there is no taxation on policy loans. This way, the cash value still earns interest because you didn't take the loan from the cash value, but you got a loan from the insurance company. You can pay back the loan on your own terms, but you're not hit with penalties. In a previous episode, we talked about when we talked about insuring our children, we used an IUL example which structured for death benefit. In example one, the focus is on cash value growth. Isaiah, age 30, wants to buy IUL. He understands the benefit of growth, but that's not losing money. So he wants to use this as one of his retirement vehicles. So he puts in $300 a month. At age 70, he would have $384,064 of cash value with a death benefit of $788,599. And this example is a modest example, even though he put in 144,000. At age 100, he would have over 1.1 million in cash value and a death benefit of 1.5 million, having put in a total amount of $252,000. Mary, in example 2, age 35, isn't concerned about the cash value portion of the policy. She only cares about having her death benefit last to age 100. And the life policy and excuse me, and for the life policy, her premium is $59 a month for the $100,000, which will last until age 100. Now, at age 65, the premium is the same, and the face amount is still $100,000, and the cash value is $33,009. She put in the minimum premium and took it to age 100. It's a little high in the beginning, but it doesn't lapse or go up in the later years, even though at $59 a month, if she bought a term policy, it wouldn't be $59, it would almost be half of that. However, in this scenario, what would happen is if it was a term policy, it would end in 22 or either 30 years. Whereas paying $59, her premium lasts well over that same time period. There are many examples on how to structure an IUL policy. It costs more than term in the beginning, but it doesn't end until age 100 to maybe age up to, in some policies, 120. And we're also assuming that you're going to continue your premiums. Some agents believe that this should be your only retirement vehicle because of the tax benefits. I'm not in agreement with that because I believe in diversification. It's not wise to put all your money into one vehicle. You may use IUL as one vehicle, but I would consider other options such as Roth IRA, 401k, 413, 403b, etc. I like making sure you have proper coverage when you die. So I prefer using IUL not necessarily as retirement income, but for insurance coverage. However, you may use it as retirement income. I don't really advise that as many other agents do, just using it as a retirement vehicle. In our next episode, we will talk about whole life insurance and do a comparison on IUL and whole life insurance. I've been getting requests to talk about tariffs, and we'll get into that in an upcoming episode. So stay tuned for that as well. I want to thank you for tuning in the show today. Please tune in every Wednesday at 7 p.m. and we'll continue our discussion on insurance and money. I have more examples and tips to share. This is Karla signing out until next week.